there was a real risk that American Express would go bankrupt at that stage. Buffett put 40% of his portfolio into the stock. It recovered. He bought $13 million worth of that stock. That position today, if he had held it, which he didn't all the way through because he's changed investment entities, but that position today is worth something in the order of $14 billion, which is an enormous return. So he learnt from that it wasn't necessary for these things to have a liquidating value. He could, in fact, buy them on the basis of a franchise. He made sure that people were still continuing to use American Express cards. And so it taught him that there was a different method of investing. So in 1972, he found See's Candies. It was earning something like $2 million on $8 million of invested capital. They paid $27 million for it. He assessed the value in the order of $45 million, so he got a fairly substantial discount. And he said at the time, when someone asked him about it, are you still a Grahamite type investor? He said, I'm 85% Graham, 15% Phil Fisher, who recommended the scuttlebutt method of investing, which is you go and find as much information as you can about the quality of the business and its ability to grow. So See's Candies between 1972 to 2011 returned $1.35 billion to Berkshire Hathaway, which they've continued to invest. And it's required only something like $70 million reinvested in the business to generate those earnings. So that's what's known as a franchise. The lesson that he took from investing in See's Candies was that you're much better off with these businesses that are able to grow over a long period of time. He said, though the cigar butt might have a single puff left in it, and that puff is pure profit. After you've smoked that puff, there's nothing left. So he stopped being a cigar butt investor and he became an investor in wonderful companies at fair prices. Looks at Buffett's investment methodology and says that's been very lucrative for a very long period of time. Assuming that we don't have Buffett's great mind, are we just able to create a quantitative version of the methodology that Buffett describes in the little book, in his letters? And he wrote a book about that process. And so he decided that good quality as defined by Buffett means a high return on invested capital. So invested capital is what it actually costs to run, the money that you need invested in the business to run the business, the assets of the business that are actually used to produce income. The higher the return on invested capital, the better the business, the faster it's able to grow. And for valuation, he uses an earnings yield, earnings before interest and profit, interest and taxes, because it's agnostic to the capital structure, where interest payments on debt affect the tax that you pay. If you back out interest and tax, then you get this idea of the operating earnings that are coming into the business. We tested this in quantitative value, and we found that the magic formula does in fact beat the market, a comparable market of stocks, and quite comprehensively. It's beaten it by 3.5% each year from 1974 to 2011. What is really shocking is that the earnings yield alone, what I describe as the acquirer's multiple, beat the magic formula itself, and the quality measure actually underperformed the market. The quality measure was actually led the magic formula to underperform the earnings yield alone. And it's not just a performance, it's not just a raw return story, it's in fact a risk-adjusted return story as well. The earnings yield alone generates a better Sharpe ratio and a better Sortino ratio, which is basically the amount of growth relative to the amount of variability in the returns. So you get better returns and you get better risk-adjusted returns just using the earnings yield.